So we brought along three names today, and let's start with a big global bellwether. This is Caterpillar. But when we talk about Cat, let's talk about where it's come from. It's only 18 months ago that this was a $90 stock. So it goes 90 to 170. And then we think about 2018, it's basically been in this 20% drawdown all year. We think it's hated enough where it's probably worth a shot on the long side, but we have to use a tight stop. That 132 level, those are the lows from a couple weeks ago. It has to be your line in the sand here. You start to get this above 142, 143, you can make a case that it's resuming trend. So use that stop in your 132. Let's go to biotech here. This is Amgen. It's been basically unchanged since it reported last week. This is one of our favorite long-term pictures in the space. It's been in this massive base for the better part of the last 4 or 5 years. 130 on the downside, 200 on the high side, pushing up against that 200 level. That gives us a target of about 270 should it break, should this one break out here, which we suspect that it does. And then lastly, this is Amex. I think what's curious about Amex here is higher low when it bottomed in January, higher low in March, higher low in June, testing that level right now. We think that risk reward here near 97, 98 is interesting. But again, let's be careful about our lines in the sand. 95 would violate the thesis. So that's our line in the sand. But ultimately, we think that risk reward here is interesting.
Come on over.
Whoa, got it.
That was right over.
No,
it's
very
like,
authoritative, just, matter of fact.
Come on over.
It's going to happen.
Was I going to leave it to you guys?
Happen, and it is going to happen.
I don't know. I mean, it doesn't matter what I was going to say now.
Because that's why I said come on over. I mean, I get the technical story, but nowadays you have to take so many other things into consideration. Now, Caterpillar is a perfect example. It's like China, China, China. You can tell me technicals all day long, but I've got all these other variables to worry about.
I'm going to challenge that view a little bit. You have the S&P up 5% year-to-date, 7% on a total return basis, and the headlines for 6 months have been about as bad as anyone could have ever written. So the broader market's been really resilient in light of this. So if you're a believer that this bull market in stocks is not over, and you have a name like Cat on pretty good earnings, down 20% from the highs, it's probably worth a shot on the long side if we're very strict with our stops. And, Dan, we talked about 132, 133, I think as really the line in the sand here.
It was a beat and raise quarter after the high watermark nonsense of the 3 months ago.
The biggest issue was how that stock reacted. It opened up, 3-4% or something. It was trading even higher in the pre-market, just gave it all back and closed down. That was earlier in the week, I think, on Monday.
But think of the headlines we've had, and I think this is what Scott's talking about, even though I agree with what Chris is saying. I mean, Caterpillar is the poster child for what's going on around the world, especially in terms of machinery demand. And the headlines in the last 24 hours have been awful. Look at steel companies. Look at other, highly correlated names. So
you just think about how the market responded today. At one point last night, S&P futures were down 20 handles and goes up 20 handles, right? So 40 basis point reversal here on the spiders, right? Pretty decent action considering how negative the headlines were overnight. Then you look at some of these industrial sector peers of CAT actually quietly acting a little bit better. The 2-week industrial S&P spread is as good as we've seen since mid-2016 right now. So some of these other names have some momentum. They're worth taking a shot on here.
Amgen, what do you guys, I mean, healthcare, as sort of been saying, it's like the greatest trade no one's talking about.
Guy talked about it.
But it led the market. It led the market in July.
Healthcare's been, we talked about value versus growth. I mean, one of the value places has been in healthcare. And Amgen specifically, we talked about when they reported, we said, look, it's got to close above 200. I think that's the point Chris is making. Otherwise, you have a major double top from the beginning of the year. But on valuation, it's hard to knock Amgen. And if it does close above 200, it probably sets itself up for the next leg higher in the stock.
What was important about Amgen's numbers is, like a lot of these biotech companies that you worry about their product pipeline and what's fallen offline, they've got migraine coming to the top line. Repatha is getting better. I think the stock's very cheap. It's got a great balance sheet. I agree with Chris.
And guys, this is not the only one. Look at Lilly, look at Pfizer, look at Medtronic. There's a whole bunch of them acting a lot better here. I think.
No, that's why we bring it up. Many of them are up double digits over the last month, and that's why the sector itself has done well. What about Amex? Anybody buying Amex today? Would they?
I just want to make one point. There was another stock, PayPal, that Bob Pisani talked about. I think the way that those two stocks reacted to kind of disappointing quarters was
PayPal
kind of...
and Amex?
Yeah, both of them, they were just down a little bit. What I'm saying is they didn't get killed, and I don't know why those were in there. So I actually think they show some resilience, and there's some things going on fundamentally there that are pretty constructive, and the fact that the stocks didn't get killed, I think, is kind of bullish.
Yeah, and they've tried to sell this stock all year, and every time it keeps coming right back. So I think that 95 area, good level on Amex.